Welcome to Commercial Real Estate Pro Network CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Mike Zlotnik. Mike is known in real estate circles as Big Mike due to his stature, but more importantly, he is known for his personal integrity and for having a keen understanding of the financial aspects of successful real estate investing. Mike is the CEO of TF Management Group, LLC, and is a real estate fund manager. And in just a minute, we're going to speak with Mike about the best commercial real estate investing opportunities coming out of COVID-19. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Mike. Welcome to CRE PN Radio.
Darren, thank you very much. I appreciate the opportunity to join your podcast radio show. And delighted that it's a small world. We chatted about this a little bit. You're in Portland, we're in New York, and we're close with some friends, with folks that live in your neck of the woods. So
yeah, and I know my neighbors. That's awesome.
That's kind of a small world. So thank you for having me.
No, glad to have you. Hey, before we get going, Mike, if you could take just a second and share with the listeners a little bit about your background.
Sure. So I grew up in the former Soviet Union, and when people ask me where you're from, I say from Russia with love, like James Bond. Originally, actually, I'm from Moldova, not Russia, but my native tongue is Russian. I immigrated from the former Soviet Union to the United States in 1989, so as a political refugee. So I'm a U.S. citizen and the U.S. patriot, and so that's kind of the origins. I live in Brooklyn, New York. Married to my lovely wife for 21 years. I have 4 kids and a cat, the 5th child. Those of you who have a pet can appreciate what I'm talking about. And previously, I had a career, almost 15 years as a software executive. So I'm a mathematician by education and spent years in that industry. But in 2000, I discovered real estate, made my first purchase and continued acquiring assets from there, and discovered that's the best asset class. And I never looked back. 2009, I quit my last IT job. I went real estate full time, starting managing my own investments as well as investor capital. And it's been a journey since then. And today we invest in a broad range of commercial and residential assets, from performing to distressed debt, from multifamily self-storage, conversion of hotels to affordable multifamily housing, industrial, even cannabis farms. How about that? Pot farms. We have debt on land, well, not conversion, but permitting for cultivation. So it's a strategy, and we're pretty flexible, dynamic, looking for greatest operators and greatest opportunities, and that's what we do.
Awesome. Well, I'm impressed with the kind of the width of your different asset classes. I think so many times I find people that are kind of, they're married to one and will write it up and write it down, as opposed to recognize the opportunities that are in other asset classes. Can you speak a little bit to that? How you are comfortable with all the different asset classes?
Sure. So using the Wall Street term, we are allocators. The way to think about what we do is we're allocators of capital into the best opportunities during different market cycles. And so I think of myself as a diversification manager. and the capital allocator. That's primary strategy, kind of what we do. As far as building expertise in various verticals, such as self-storage, multifamily, industrial, as we make investments, we've been learning over the years what works, what doesn't. Obviously, commercial underwriting has a lot of stuff in common. Obviously, cap rates, interest rates, sensitivity of NOI to the top line, to the bottom line, expenses, all this stuff is sort of similar in nature, but knowing a specific industry is important. And we've focused on picking the right sponsors. So the game has been having a vertically integrated sponsor, so someone who does distressed debt in New York City, and that's all they do. So we'll allocate capital to that to the extent of the diversification strategy, as well as the deal flow gets better or worse with the market cycles. Similarly, as I mentioned, cannabis farms. The only reason we invest with that in that industry because we know a very competent operator who figured it out, built the connections in Lake County, California, and they're able to get their permits done faster than the rest of players. So that's the way to think about this. Pick the right operators, specialists. If they're worthy people, you can know, like, and trust. You can execute the strategy with them, and then we obviously learn as we go. We adjust, we observe. So that's been kind of the approach. The way to think about this, everyone loves Warren Buffett. Well, I don't know if loves him, but knows who he is. So Warren, and if you read what he does, he's only about three things, really. Obviously, companies he wants to buy or investments he wants to make, right? The dollars he wants to put in those investments, and then the people to run them. We use the same basic methodology in the reverse order. We start with people, then we decide what dollars we can write into a strategy within our diversification, and then obviously the projects. So it's the projects and then dollars. So as we know, we have a $2 million bucket in distressed debt, and we look for projects. And if the worthy projects come along, can we get it at the right economics, at the right waterfall? There are plenty of great operators with so-so deals. It has to be great operator, great deal, and then the right, obviously, dollar amount. So I don't know if that helps, but at least that's just how I think about the whole exercise.
No, I think it definitely, it clarifies it as opposed to, those that are focused just strictly on an asset class. You said, you start with the operator. I mean, knowing the operator, but also understanding the opportunity, and then getting into if I understood right, getting into the details on the project. So you have to have a good operator and a good project for something, something that you would be interested in investing in, if that's kind of what I understood, right?
Yeah, exactly. So, and we start with the relationship. I'll give you an example. We're working on a new opportunity, kind of, new. I mean, it's been around. The concept is old, but I go to a number of masterminds. One of the masterminds I go to called the Collective Genius. It's kind of very interesting, a very cute name, but it's movers and shakers in real estate. Some guys are residential, some guys are commercial. To make long story short, I met a couple of new guys there, and their whole strategy is they buy land for cash, and then they sell it or seller financing to people who pay them on a credit card. So they'll buy a lot for $3,000, $4,000, $5,000. They'll sell it for $18,000 to $20,000 on a payment plan, $250 a month for 72 months. It's a massive receivables business, but their real business is a technology business and marketing, but it has real estate as the product. So when I looked at this stuff, what's really interesting is this was new and we never done anything like this. First thing we did, and you and I both know Verivest. So I send those guys to Verivest to get Verivest verified because I have great relationship with Verivest and Lens. And once they got Verivest verified, I knew these guys are clean and they're good guys. Then we underwrote them. We gave them a hard money loan, effectively secured by their portfolio of all these massive receivables. So yeah, it's a different strategy. It's new, but I thought it was a great deal because they could afford to pay us better than market rates. Well, the market is obviously subjective, but it's a niche product. So the way to think about this is a niche loan. And we found, and we're working with them, and we're working with expansion. Their strategy continues to grow. We'll continue to invest more capital with them. But this is an example of kind of discovering a sort of new to us strategy with a good operator. So we started with due diligence on these guys. Two, we gave them a small loan and they're performing. And as they continue to grow, we're looking to do more business with them. So the strategy is fairly straightforward. Is this a commercial real estate? In my view, it is. This is an example of real estate mixed with a business, right? You have self-storage, you have senior living, you have semi-operating business. It's a real estate component, but there's also operation. And it's critical to pick the right people who know what they're doing. Right? I mean, we could talk about senior living. You could buy a bunch of senior living facilities. If you have a terrible operator, the business falls apart. Same is true with self-storage. It's a critical operating business.
So let me ask you, I mean, knowing that the operator is the key to all of this, what are some key, indicators that you look for when assessing an operator?
So we always start with obviously the basic background check, and I mentioned we're relying now on Verivest to run this for us, right? So as long as the history is clean, or they can explain what has happened in a succinct manner, at least it's a start. Two, what look for is well organized documentation. I can't understate this. If they give you great documents, underlying spreadsheets with KPIs, and they know their business, you know it immediately. So in that business, one of the critical KPIs, new lots acquired versus new lots sold on this financing. If they're tracking that, they're not getting stuck with inventory. So getting well organized KPIs and data is very valuable. You get a sense whether they know their business and how well, right? And obviously understanding how they make money. Pretty obvious, running the math. So what I do want to see is a business model that has a pretty strong foundation. So risk levels. So the other thing is we look at. I mean, we talk pre-call. You're the master of the risk assessment. The risk is probably one of the most fundamental things. What can go wrong with the strategy? So I looked at this, and land is not going to have a problem of it's not going to depreciate. You're not going to have buildings that's going to crumble. The strategy doesn't have a lot of downside other than these guys turning bad and somehow disappearing with a bunch of cash, which is a risk, right? But if you can eliminate that risk through the background check and understanding who they are and having some controls, but at the end of the day, if the operator is high integrity and that risk goes away and the asset class itself works and they don't run into a problem of too much inventory, the business feels very solid from the investment perspective. So I would say fundamentals of the business. That's the way to think about it.
Is there any kind of a timeline of experience that you look for? I mean, all of these things that you've mentioned suggest that they've been in, that they're a proven entity. Is there any kind of a minimum years of experience that you would look for?
So that question is a let me put it this way. I'm not looking for somebody who has 20 years of experience in this. If they have 20 years of experience in this, they shouldn't need my money.
Right.
They just shouldn't. They should have built great business and were bankable, financeable. So these guys have a couple of years of experience. To me, they have 2 strong years, and these guys are young. So I see the path. If they're on the right trajectory, we're catching them before they've gotten too big, too strong, and they're fully bankable with traditional money, with a bank capital. So a couple of years, I would say, of general experience is sufficient. Obviously, they have not seen market cycles. So what is important is more monitoring. But they've agreed to this, and they're providing monthly reports, and they're demonstrating what's happening. As long as that's in pretty good shape, I don't necessarily need 20 years of past experience and a resume that has Wharf called on paper, but can they still operate? As you know, you could have been great 10 years ago, and now things are falling apart. So let's just call them, like you look at trailing 12 when you're acquiring anything. That's the key.
Right.
What is the trailing 12? If the trailing 12 looks good, that's an indication.
Gotcha. Well, I appreciate you kind of diving into that a little bit. I think that, the operator is clearly kind of the integral piece, or I mean, the kind of the tell of whether or not, or at least what I've seen. I know in insurance, if the operator has their act together, things usually run pretty smoothly. If they're always trying to shade things in a particular way or make things fit in a particular way and ignoring, the facts, it makes for a difficult go. And I mean, I'm sure that kind of plays out in your business as well. Um, Let me ask you. So, uh, in your experience with the different types of investments that you are placing and the capital that you're placing, right now we're in the middle of the COVID-19 pandemic. If you were to compare your experience and what you guys were doing pre-COVID as opposed to what you're looking at going forward, can you kind of make a comparison for us based on asset classes and strategies and where the opportunities are or
Sure.
were versus
So,
are?
yeah, I mean, it's a great question. I would say that the time horizon has changed. When everything is running well, and we were a little bit more aggressive, um, and as COVID hit, it's a wake-up call. And what does it mean? It means we're looking for strategies where we could get to the value add phase over shorter amount of time and getting to stabilization faster. Now, it's not the only strategy. We'll obviously invest in deals that have great fundamentals, but they take longer to execute. But in general, I would like to see faster path to cash flow because one of the variables or uncertainties of COVID is the cash flow. If tenants are not paying, well, it's a big risk. And the other adjustment is what is the risk to the cash flow related to COVID um, dynamics? So specifically, cannot evict, cannot foreclose, right? So we're making loans. We're trying to be extra careful now. We're going to have difficult time with foreclosure if it's a default. Obviously, picking the right operators, we can't understate that. That is the most fundamental thing. If you pick good people, you don't have to worry about the foreclosure risk and so on. It starts with high integrity. Obviously, if you pick shysters, doesn't matter what. I mean, they're going to figure out a way to cause grief. So I would say COVID risks obviously come into play. How is this asset specifically impacted? So multifamily investing today has that risk for sure. But what asset class are they? Is it Class A, Class B, Class C? Section 8. One investment we made in the middle of COVID, we were very comfortable with it. We invested with another member of the Collective Genius Mastermind, who is, I call them the biggest shark in Mobile, Alabama. So forgive me, I'm out of New York. I don't know. I didn't know where Mobile, Alabama was on the map. So my ignorance. But obviously I know now. And he was buying a portfolio of 93 single-family residential properties. Right. So I looked at it as a commercial project. It's basically a package, and they're all within 15 minutes drive from his office, and he owns hundreds and hundreds more. So he can manage the portfolio. And 90% of the portfolio was Section 8. Right. And so the safety of the income stream was related to the government payments. That's why we invested, and it's cash flowing like a monster today. Because he bought it less than 50,000 a door, and they're renting 850, $900 a month. So from that
Wow.
perspective, you can get pretty good yield in a portfolio instead of multifamily. Go find multifamily asset; it's harder. But this exercise was a precision of doing it with the right operator, and in the market that is cash flowing substantially, and then obviously doing the due diligence on the project and the deal. So here's an example of a justice strategy in the middle of COVID. The other strategy, we did make another investment in a substantial value add multifamily in Indianapolis, almost 1,000 doors with a very, very competent sponsor. And we were nervous about where things going to go, but the sponsor experience and the track record and ability to execute strategy and the rents below the market kind of helped us to clear that bridge. So if you have a very competent operator, they have a good track record of executing a similar strategy, and you're picking the right asset in the right location, then you can go with that. And the deal obviously had great economics and the right type of a waterfall and right depreciation benefits. So was it the unique thing about that deal on top of all this, it was a value add strategy that had cash flow from day one. So if you ask me what has changed in the past, I wouldn't care about the cash flow. Uh, Now I do. I would like to have the safety margin of some cash flow from day one as a buffer against problems. So that's a COVID investing. So
No, that that makes a lot of sense. And I'm just kind of curious. You've emphasized the quality of the operator, their experience. Um, is there, and it sounds like you maybe answered the question with just saying that cash flow is more important now than it was historically. I know, like I've heard multiple times from investors how the lenders are requiring additional capital and reserves, kind of thing. Is that factoring in anything that you're doing, or when you're underwriting deals, are you looking for more cash in reserve to weather any kind of storm that might still be on the horizon, or lack of income, or?
yeah, for sure. So I've developed educational methodology. I call them 4 quadrants. A lot of people have 4 quadrants. Robert Kiyosaki has 4 quadrants. I have my own 4 quadrants. So what I like to focus on, what I call in quadrant 1 and 2, these are sort of investment grade quadrants. And I'm not selling this methodology. It's simply the way to think about this is buffer reserves. So if it's an equity investment, is there substantial debt service coverage ratio, and then obviously reserves. So the quadrant 1 deals are the deals that have a cash flow, have substantial reserves, a healthy DSCR, and a little overcapitalized project with extra cash always helps. Now, the bank's requirements sometimes help, right? If the bank says, "Hey, you need 6 months of interest reserves," and I'm keeping it, well, that's great. That in fact requires overcapitalization because that cash has to be in the reserve account. So I don't mind that at all. In fact, I like it. Lower leverage is one thing that I've looked at recently. Most people want to get higher leverage. More than happy. So this trend, the aggressive operators will go to a bridge lender and they'll get 85% leverage, while the conservative lender will say 70. But the effective benefit of a lower leverage is you can actually get a lower rate. So it's two-way savings. So looking at the max leverage, it's a two-way sword. If things don't go well, you can get wiped out faster. So I would say,
Right.
yeah, looking for lower leverage, maybe a little bit lower target ROI, as long as the safety of the income is feels better. Just feels what I call in quadrant 1 and 2 deals. The speculation element is lower, and it's safety, which again, cash reserves, lower DSCR, simpler strategy to execute, is what I look at.
Have your time horizons changed at all as far as pre-COVID now? I mean, and I think you did hint at it. You're looking for quicker cash cash flow, or you even kind of said cash flow. I mean, from day one is kind of what you're looking at. Are you looking for deals to go full cycle faster, or has your expectation for a deal cycle um, changed at all?
Yes, another great question. I would say that the path to stabilization, 18 months to 2 years, if you can execute that full strategy. Now, if you're renovating a lot of units, can you do it during that timeline? We haven't talked yet, but I do like the hotel conversions to affordable multifamily. That whole strategy is pretty healthy. Generally, extended stay hotels that are easy to convert, that look like apartments. Most of them can get to the stabilization point within 18 months. Now, can you enter into the similar asset class on an existing multifamily? It's harder because you have an asset class that's distressed now. You can pick it up at a better price, and it's an easier conversion path. So I would say that because you're going to get through, you have an empty future apartment complex, so you can execute the strategy versus you have a full apartment complex where you have to gradually do it. And I don't mind the gradual strategy, which has better cash flow from day one, but sometimes you can go into more value add, more speculative, as long as there's a very competent operator, fairly straightforward conversion process. right? And obviously sufficient reserves to be able to pay for the budget overruns. Budget has to be conservative too. If those elements are good, you can run into sort of a value add strategy faster. Basically, you're entering the strategy without fear of something getting stuck. It's the risks. What can go wrong? So if in this project the risks of things going wrong are lower than in faster path to stabilization, I like those projects more today. So that's the kind of the way the view of the world. What else can be done to reduce risks?
Now, I like that conversion strategy. Are you seeing a lot of that? And if so, are there any particular market characteristics where you see that playing out?
Yeah, it's a non-major MSAs, right? You could do it in New York, but I don't know I would want to do it in New York. There's a massive oversupply of condos in Manhattan. Why would I want to take a hotel in Manhattan and try to convert to more apartments? Not a good market. But if it's a project somewhere in Midwest, Southeast, secondary MSA, smaller market, and the key is location of that property. If it fits right into the residential neighborhood and it's a good location, what I do like proximity to universities. So if you have universities, you could have potential for off-campus student housing. So instead of paying on campus price, they could pay off campus, have the privacy, have a better living conditions, and a pretty easy commute. Um, so that these are the kind of the characteristics. So it's the location within the city and the town, and then obviously easy conversion. You don't have to do extended stay. You could do sort of a traditional one, but extended stay is ideal candidates.
Right. Well, I know I've talked to other guys that have done that. It wasn't exactly their first idea, but it made sense. But I would think with the extended stay, you've already got some sort of an semblance of a kitchen in a lot of those, where some of the smaller traditional motel kind of a thing, you may not have a kitchen as much as you just have kind of a bathroom, and some of the the capital expense required to add the kitchen. I mean, I guess if you buy it right, and like you said, if you're starting with an empty property, there's not going to be any resistance to moving through it versus a full property kind of thing. But I can see it both ways, I guess.
Exactly what you said. If an extended stay hotel has a kitchenette installed, that's a massive help, right? I mean, it saves quite a bit of money. It may look a little bit, if the hotel is not new, it may look a little aged. Well, it's antique. It's
Well,
it's
but
it's
just even the
boutique. It's
behind the walls, I mean, I guess your guts,
plumbing, everything
yeah,
else. Yes.
you can hook up new fixtures and make it look all pretty, but just the behind the walls kind of thing gets kind of expensive. So,
Yeah, that's an ideal setup. The secondary opportunity becomes, like you mentioned, a hotel that looks like a motel. These are sort of studios. And
hmm
what's really interesting, years ago when I was in college, I lived off campus. This is many years ago in a motel right next to the university, and essentially they were missing they were missing kitchenettes, but students still lived there because it was better for privacy. So if you can install a small kitchenette and you can cook, it works. It absolutely works. It comes down to the price. Folks who rent in these type of assets are very price sensitive. The price makes a big difference. So the product has to be extremely competitive.
Gotcha. Hey, you mentioned some of the asset classes. You had touched on storage or self storage. Are there other asset classes that you see are potential opportunities coming out of COVID?
Office conversion to multifamily. Uh, Pretty obvious that some office buildings are dysfunctional, as well, at least they're not, they've lost at least some number of tenants, and it's a good conversion consideration if it's got the right location. So I would say that's all local. I mean, if you find the right asset, if the conversion path is cost effective, I think there is an opportunity there. Also, there's a lot of retail space that needs another home for sure. So the classic big box retail conversions to self-storage, that strategy has been around for a number of years. It may still make sense under some markets. The cities don't want it anymore, but if there's a creative repositioning of retail into some housing, which is it's a harder play, right? It's not designed for that, but it's a possibility people can potentially find, economically feasible projects. And then the rest is really, our world is very opportunistic with people we know. It's like it's not a necessarily a massive opportunity in a given sector. It's more that I like the cannabis play with the land conversion to land permitting for cultivation if you're in the right market. The whole country seems to recognize that, and it's no longer a taboo. It's very friendly topic. I like that strategy. I mentioned to you some of the newer things we've been doing with land. Kind of interesting play um, if you can buy the right at the right price. The reason I say that because it's really marketing and technology business. Getting to the sellers and getting them to sell you the land is a skill. And if you're the right operators, you may be able to make money in that field. That strategy has been around. So people have done this for years, and it comes around in cycles again. And if you buy it right, almost hard to go wrong. Um, Infill, obviously. So again, back to the land. Uh, there, this continues to be interesting strategies in cities. If you find the right type of location and you can redevelop or develop ground up for affordable. I have a friend who he's a pastor. He's a pastor in Los Angeles, and his strategy is pretty interesting. He goes around the city and finds other churches that have land that they're not using, and he basically offers them to develop the land into affordable multifamily housing. And he figures out economics, and generally the churches kind of like the idea. Now, is this post-pandemic to pre-pandemic? He had the strategy before COVID, but now it's even more relevant. Again, housing seems to be the need for affordable housing is accelerating. So that's kind of what I see today.
Yeah, no, that's. I know here in Portland, we've certainly got our share of housing issues. Um, Let me ask you: is there a particular size of or a range, or can you identify what's a range of opportunity for you as far as dollar size?
Sure. So we are relatively small. I mean, there are institutional players who write bigger checks, but today for us, the sweet spot what we write today is between half a million to a million to a project. There's no right or wrong. We can write a bigger check. We've done projects where we've written bigger checks. I'll give you example, the project we did that in Indianapolis, the big 90, almost 1,000 doors. We wrote a $3 million check, and we sold off the rest through a sub-syndication. We spun out a separate deal. The deal was just so good we couldn't pass it, so we wrote it a bigger check, and it helped negotiate the terms, obviously. So we're open to the idea to write a bigger check, but from a diversification perspective, we'd probably want to have less exposure than that amount. So today, as I mentioned, half a million to a million. We're writing some bigger checks, but it's a sweet spot today. So
No.
we're pretty happy to take a piece with these hotel conversions. Or if you are leveraged and you're all in $6 million, you have $4.5 million debt, $1.5 million equity. We're happy. It's almost perfect match for us. We'll take a good chunk of it, if not all of it. So that's kind of the way to think about it. Small hotels, just kind of that whole space with your equity raise anywhere between, from let's just say half a million to 5 million. This is where we're happy to participate.
And do you like coming in on the equity side, or do you like doing the lending, or both? Or you agreeable?
Yeah, so we execute the strategy as we have a few funds. So the Tempo Growth Fund is a growth fund. It basically takes growth positions generally, so it's equity. Typically, Tempo Opportunity Fund is more of an income and growth fund. So we like as much as we can to take a debt position. We'll take debt with an equity kicker if possible, or primary debt or mezz debt. We need debt because the fund has more of an income focus. For tempo growth fund, it doesn't care. As long as the risk-adjusted return is healthy, it's fairly flexible either way. So there's no right or wrong. It really depends on the project. The cannabis farms, the pot farms, that's what I call them, the land conversion. The owner is not willing to give enough equity on the projects. So he's perfectly happy when we record first lien mortgage and have hard money terms on that, and we have an equity kicker. Right. So it works for the sponsor. It's really negotiation, right? It depends on what you can work out with the right sponsor and what are your kind of risk adjusted return dynamics.
Got it. Hey, Mike, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with risk. And there's three strategies we typically consider. We look to see if first we can avoid the risk. If we're not able to avoid it, then we look to see if there's a way to minimize the risk. And if we can't avoid nor minimize the risk, then we look to transfer the risk. And that's what an insurance policy is. I like to ask my guests if they can look at their own situation, your business, your clients, investors, the market, however you want to identify. But if you can take a look at your situation and identify what you consider to be the biggest risk. And for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. But if you're willing, I'd like to ask you, Mike Zlotnik, what is the biggest risk?
So great, Darren. Thanks for that. Three ways to manage kind of risk: avoid it, mitigate it, and obviously transfer it. When I grew up being a mathematician, so we've looked at risk too, and I've learned there's two elements to risk. Number one, it's likelihood. Number two is impact. So what I do is I look at risks and try to figure that out. So likelihood and impact are the two key variables that drive all the decisions. And I would say the number one risk on a grand scale of things, and for the entire real estate market, and I think about it, it's not necessarily my biggest fear, because I feel that the impact is huge and the likelihood is low, very low, but the interest rate's going up a lot. So take a look at what has happened to the 30-year bond, where we are recording this February 10th. I don't know when it's going to come out. Maybe it's live, but I looked at the data since the beginning of the year, and the 10-year Treasury and a 30-year Treasury moved quite a bit. The yields have gone on a 10-year from 0.94 up to 118, if I maybe it's fluctuating obviously, and on a 30-year from 1.66 to 1.9697, in that range. And these are very substantial moves. If you are a bond investor, you lost 20, maybe even more % of your investment in 30 days. This is how sensitive this stuff is. And the whole real estate industry is heavily dependent on low interest rates. It's like a fuel. When the rates drop, it's a fuel for real estate fire. When the rates climb, cost of capital goes up, cap rates go up. Now, this is directional moves. But what the United States is doing, they're printing a huge amount of debt. And they're basically borrowing and spending the money for the stimulus and everything else. So our debt to GDP ratio is getting out of control. Nothing new here, right? We've known about this, but it's getting progressively worse. It's the risk is accelerating. So there's only one solution, unfortunately, that we've seen it in the world out there. It's the Japan model. The rate's going to go negative. Now, as crazy as it sounds, it's the opposite of the risk that I'm talking about. So if the rates go negative, it probably will be pretty good for a lot of real estate investors, as the cost of capital will drop. But there's also a possibility of effectively runaway inflation as the government continues to spend without the brakes. Unless Fed comes in, it's basically a manipulation of rates. The Fed has an unlimited checkbook, and they can buy all the bonds that are issued by the Treasury and push other rates down. But at that point, what do we have? We have a central bank that buys everything just to get the rates to the point where they can service the debt on on the liabilities of the United States government, unfunded liabilities plus the real debt. So the problem is this could turn into a runaway hyperinflation, and the rates will actually jump substantially. And it happens, it will be essentially massive devaluation of the dollar, and it can happen. I've seen other countries do this. So the strategy of artificially keep the rates lower and lower and lower, it works until it doesn't. And if it doesn't, there comes a cliff, and that cliff triggers hyperinflation, and it could cause substantial grief on the all the lines, everything rolling. The debt service, it'll be massive squeeze because of the debt to GDP ratio is so out of control that if the rates climb, uh, uh, we have a massive collapse of the oversized debt portfolio, the whole national debt plus all the private debt. So it's a possibility, it's a risk. What can you do about it? It's hard. It's hard to come up with a great strategy. Obviously, likelihood is pretty low. I do think that the Fed will not let that happen in the long run. It's just they can't. I mean, we're going to have a bigger crisis, a different type of crisis than we're dealing with now. Um, you could sort of play some derivatives to protect yourself. You could build, if you're an expert trader, you could hedge against that. But in the short run, I would essentially caution people who don't think the rates can go up. They actually can, and they are showing some movement today.
No, I appreciate you, getting into that. It is something that I think I'm aware of, but like you said, not much I can do about it. But more, I guess, be aware of it, and I would assume as a defensive strategy is not being over leveraged, or keeping a higher degree of cash in the deal kind of thing, as opposed to, like you say, going all the way in on debt.
Well, that's right. It's a sensitivity study. If the rates fly up fast, these assets will be selling at higher cap rates. So just doing some analysis on sensitivity study as a sponsor, what you can do is assume, hey, the pro forma sale price is based on a 6 cap, right? What happens at 7? Can you still survive? It's exactly lower leverage. So be more conservative in your investing decisions, and have more cash. The solution when the rates go up and you got to refi, and the cost of debt is going up, is to bring more equity. So not a very popular exercise, but it's an option. Can you deal with that type of situation? We haven't seen this in the longest time, and honestly, you're asking about a risk. It's a risk. Likelihood, I think it's low, given where the world has gone, and we've seen examples of Japan as a classic model because their debt to GDP ratio is worse than ours, and they've had no choice but to go there. So I think U.S. is more likely, from a likelihood perspective, that scenario is a higher likelihood than the scenario of a hyperinflation and the rates getting out of control, on the higher side. So both scenarios present different type of risk and different type of problem, but as an investor, you have to be sort of prepared and at least think about what would happen in either one.
Got it. Well, hey, Mike, want to say thanks for taking the time to talk today. I've enjoyed our talk, learned a lot, and hope we can do it again soon.
Darren, thank you kindly. I very much appreciate being a guest on the show.
Before I forget, Mike, I apologize. I meant to ask you, where can listeners go if they'd like to learn more or connect with you?
Sure. So it's a little cheesy, but It's a personal brand. It's just people. This whole Big Mike, it came as a suggestion from my mastermind guys in the collective Genius. They said you're a big guy. You're 6'4" on a heavy side. So Big Mike Fund. So bigmikefund.com is the way to find me. And if you misspell it and you forget the D on the back end and you type bigmikefund.com, I promise it's not a kinky site.
Oh, that's hilarious. All right. Well, hey, Mike, again, thanks for taking the time today. And for our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.